Every investor in the stock market likes to see the stocks or ETFs that they're invested into rise higher with time. Who wouldn't? Value investors intend to buy good companies at cheap valuations with the hope that the stocks they buy into would rise higher with time and give eventually a great profit. Growth investors, on the other hand, like to see the stocks they're invested into give amazing results right from the start. Now, both these groups are right, but both the approaches have their own risks and concerns. What if I say there is an approach that combines both growth investing and value investing into one? And there is an investment vehicle available out there that gives us access to this approach. Wouldn't you want to know about that? In today's video, I'm going to go over such investing logic and one easy way that every investor can tap into. Let's check it out. The S&P 500 is the most common core investment that every investor needs to have in their portfolio. Even the legendary investor Warren Buffett swears by the simple investing strategy of investing into your S&P 500 ETF, like VOO from Vanguard or IVV from iShares. But the problem with S&P 500 currently is that it is heavily invested into the information technology sector, almost 26%. At the next highest comes a distant almost 10% away, that's healthcare, and another 4 to 5% away, that's financials at 11.5%. So you see here, the S&P 500 index is heavily tilted towards the IT sector. And make no mistake, the S&P 500 has done remarkably well since the great financial crisis back in 2008. As you can see here, you see almost a return of 400% from 2009, or more than 200% just in the last decade. But that was when money was freely available in the market. Throughout the last decade, we see the interest rates at almost zero, and then slowly they rose, and again, due to the pandemic, they just fell back to zero. The whole last decade of 2010 through 2020, when the interest rates were absolutely zero, the technology stocks were booming left and right because technology stocks rely upon cheap money to fund their operations, and that's what they got. But as we see the interest rates hiking up since last March, the S&P 500 kept going down and down through last year. Most of the growth-oriented investors also look for ETFs such as QQQ, which is skewed towards the IT sector much higher than the S&P 500, almost double the percentage here. So nobody in their right mind can actually predict how the technology sector would do in the upcoming decade, which would eventually dictate how the S&P 500 index would do. And among all this uncertainty, there are investors who even gravitate towards much riskier funds like the ARK Innovation ETF, which has done nothing in the last 5 years. It's done almost 5%. It saw a meteoric rise after the pandemic struck, rising more than 300%. After that, we see a similar decline, down almost 80% through end of last year. Now, the ETFs such as ARK target companies which simply go by the mantra that says growth at any cost. They rely heavily on cheap funding, and we saw what happened last year when the rug was pulled off their feet. So that's where we come across the strategy that's called growth at reasonable price, in short, GARP, GARP. In this article from Investopedia, it simply says it combines tenets of both growth investing and value investing to select individual stocks. GARP investors look for companies that are showing consistent earnings growth above broad market levels while excluding companies that have very high valuations. This is an excellent point. Growth companies, after some point, they become ridiculously pricey. And when they do not keep up with their expected results, they are just clobbered by the investors. So with that said, I've come across an ETF, SPGP, which is Invesco S&P 500 GARP ETF, which in the last 1 year is down just 1% compared to S&P 500 that is down more than 9%. When I extend the timeline to 3 years, we can see SPGP doing 41% compared to S&P's 22%. And look at 5 years, it outperforms 91.4 compared to 53.6. And I do for 10 years, SPGP is to 75% compared to S&P 500's 169. When I add the QQQ, you can see the last 5 years, SPGP is 91.4 compared to QQQ's 87.6. Isn't this amazing? So this is the official website of the Invesco S&P 500 GARP ETF. It's based on the S&P 500 growth at reasonable price index. And this is the official documentation from the S&P. Let's dig further into how this index is constructed. Here we see the two key components. One is growth that considers the 3-year earnings per share growth and also 3-year sales per share growth. Now, earnings per share is a net profit divided by the number of common shares, while sales per share is calculated by dividing the company's total revenue by its average total shares outstanding. Now, quality and value are calculated together. It considers the financial leverage ratio and return on equity and also earnings to price ratio. So they calculate the growth Z score by taking an average of the 3-year EPS and the SPS. The quality score is calculated by taking an average of all the three components that we just saw. So a stock needs to have at least one quality factor and the value factor to calculate the corresponding QV score. So once these two scores are calculated, all the S&P 500 stocks are ranked by the growth scores first, with the top 150 remaining eligible for the index inclusion. Now these are then ranked by the quality value score, and just the top 75 stocks are selected. To reduce extreme turnover, they also have a 20% buffer rule, in which after ranking the stocks based on their growth Z score, the top 60 are selected by default, and among the current constituents within the top 90 by the quality score, they are selected in the order of the quality score until the target count of 75 is reached. So eventually we will have a selection of 75 quality stocks which are growth oriented but still have their value focus also considered. The maximum weight of each equity is 5%, minimum is 0.05, while maximum weight of any sector is 40%. Looking at how this index is maintained, we see it is calculated semi-annually on the third Friday of June and December. This is actually good because many of the passive indexes we see in the market just do the reconstitution once every year and only rebalance occasionally. So things change through the course of the year. If something were to massively happen, like the pandemic crash that we saw in March of 2020, or anything else can happen and things can change. So what this particular logic gives an opportunity for the index to rebalance at least twice in a year, which I really like about it. Coming to the basic numbers of the ETF, we see it currently has $2.54 billion. The yield is low, 1.12%, lesser than what the S&P 500 would give, but this ETF is not meant for dividends or anything. It's meant for to give you a nice growth that is not ridiculously expensive. The expense ratio is a tad high at 0.33%, but for what this ETF does, now as we just saw the indexing logic that we all saw, I feel 0.33% is justified. So currently this ETF is heavily tilted to healthcare at 25.5%, information technology is 18.5%, financials almost 18%, consumer discretionary almost 11%, industrials at 9, materials almost 5%, communications is 4. Look at the top holdings. We see Meta at 2.41%, NRG almost 2.4, and we have SCB Financial Group, DR Horton, Moderna, Corvo, Hologic, Teradyne, Generac, and finally Qualcomm in the top 10. Earlier we saw how this ETF has compared to your S&P 500 ETF or even the QQQ. Let's do some back testing for how this ETF performs. Now 2011 is where SPGP started, so that's my start year. I'm just starting my investment with just $1,000. Let's see if we don't invest anything more. The cash flows is none. I do reinvest in the dividends, whatever it may come. And here I give VOO, the S&P 500 as 100% and SPGP as the other 100. Let's click analyze. We get results from Jan 2012 onwards because SPGP started in 2011. What do we see here? SPGP current value would be 5,204 versus the Vanguard at 4,010. You see the difference here? The CAGR, the compounded annual growth rate. SPGP has over 16%, while Vanguard has 13.35. Now looking at the Sharpe ratios, here the higher the better, and that's what we see here. SPGP has 0.94 compared to 0.89 from the S&P 500. Sortino ratio, even this is the higher the better. SPGP has 1.46 compared to 1.39 for the VOO. And if we look at this chart here from 2012 onwards, throughout its history, we see the SPGP doing much better than VOO. Briefly during 2016 or 2017 is we see the line going down, but after that, it has never gone below the S&P 500. Let's do one thing. Let's go back and add the growth ETF from Vanguard, which is a VUG at 100 and analyze. Coming to the values, you see even here, SPGP handily beating out the growth ETF. This shows that the GARP approach, that's growth at reasonable price, not only beats out S&P 500 but also purely growth focused strategies. Isn't this amazing? Let's change the configuration a bit. Let's say we contribute a fixed amount. Let's say we just contribute 100 every month. The contribution is monthly. Let's also rename our portfolios for better understanding. SPGP and VUG. Click Analyze. What do we see here? SPGP returning 40,304 compared to VUG almost 33,400 and VOO almost 32,300. So VUG and VO are almost similar, but SPGP is just running away. So in short, for anybody who wants to invest slightly into the growthier side of the market, but not sacrificing the value components, this is an amazing ETF. I'm just surprised why not many know of this already. It's not a new ETF, it has been in existence for over 10 years. But I'm really happy that I stumbled into this. This is an amazing ETF to actually have as one's core position alongside your S&P 500 ETF. Yes, nobody can say that they can outperform the market each and every time, though this ETF does it, but still the S&P 500 has to stay at the core of your portfolio. And today we just saw this ETF SPGP has the right to stay alongside your core positions. Or what one can do is actually have this ETF as your core and build around it. That way you will get a nice diversity, and that's what we want in any portfolio, a nice diversification that can work together and grow your portfolio. When you look at the overlap between the VOO and SPGP, we see just 17% being common between the two, which means SPGP can fit nicely into a portfolio that has VOO at its core and can complement each other. This is great. I recently came across this new ETF comparison website. I'll link this up in the description notes below. This website not only compares the two ETFs' performance, but also the holdings. You can see a VO is down almost 11%, while SPGP is up 2.3. And here, the overlap percentage is 14% of SPGP is in VOO, and also the overlapping holdings over here. You can also add VUG into the mix, compare. So you can see VO is down almost 10% compared to VUG, down 14.5, and SPGP to 8.3. Looking at the overlaps, we can see SPGP still just makes 13% of VUG. And if I click here, I can compare overlaps between all the three ETFs. Now, this is the classic thing which I was talking about. The typical index ETFs have all the mega caps at the top of the list. You can see VO is up at 6%, VUG at 12.5, while SPGP is just at 1.38. This is what SPGP brings to the table. It brings a good diversification into the mix while providing good returns. So as you saw earlier, the index on which SPGP is built reconstitutes twice every year, which makes it adapt to the market conditions. And that's what makes it more appealing. It behaves like an actively managed ETF, though it is not. The underlying indexing rules take care of whatever the rebalancing has to do twice every year. Hope you liked this video and found some valuable information coming out of it. To get to know about more such valuable videos in the future, please do hit that subscribe button and hit the bell icon so that you get alerted whenever I post. And also that will help YouTube suggest this video to many more people out there and help grow this young channel. And until we meet in the next video, let's try as much as possible to be financially healthy. And just like our channel name, keep making those small strides towards financial freedom. See ya. Bye.